Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Lumentum.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. Lumentum has been one of the definitive growth stories of the past year.
It really has. We're going to be looking at the numbers and, the technology that fueled a price surge from around the $60 range in early 2025 to almost $400.
By the end of the year, yeah, that's a rise of over 370%. It's just staggering.
That monumental surge is the mystery we are here to solve. That kind of price action, it fundamentally changes who owns a stock and what expectations are built in. It's not just growth anymore.
It's a full-on paradigm shift.
Yeah.
And the core thesis, the story that explains that shift, is actually pretty simple.
It's the picks and shovels play for the AI revolution.
Exactly. Lumentum is the critical picks and shovels supplier. They provide the essential tools for this massive build-out.
And we're seeing that in the numbers now. Over 60% of their revenue is directly tied to AI infrastructure and cloud services. They are deeply embedded.
Right, but the tech sector is full of embedded companies,
That's a great point. So what gives Lumentum its leverage? What is the actual technological moat here that justifies such a dramatic re-rating of the stock?
Okay, so it comes down to proprietary leadership in materials science and manufacturing. Specifically, their indium phosphide or NNP laser technology.
And this isn't easy stuff to make.
Not at all. It requires extremely sophisticated fabrication facilities. And the reason this specific material is so important is that NNP lasers are absolutely essential for the next generation of optical interconnects.
The 800 gigabit and 1.6 terabit modules.
The very same ones. They're the standard requirement for training the largest AI models today. They just offer power efficiency and performance instead.
Well, it's currently unmatched. And this technological leadership, which can sound very abstract, it translates directly into market control. We've seen reports indicating that by mid-2025, a pretty significant supply gap opened up for these lasers.
A huge gap. Something like a 25 to 30% shortage.
Wow.
And that's the insight right there. When you control a constrained supply chain during a massive multi-trillion-dollar boom cycle, you get unprecedented pricing power.
It becomes a seller's market.
It's a seller's market, and Lumentum is pretty much the only reliable seller of this key component at scale. This allows them to dictate terms and, critically, to dramatically expand their margins.
And they aren't stopping at just being a component provider. They've strategically moved up the value chain.
Through vertical integration, they don't just sell you the little laser chip, they integrate it into the finished transceiver module.
Which is crucial, I'd imagine.
It's crucial for two reasons. First, it transforms them from just a vendor into a real systems-level partner for their big cloud customers. That gives them better visibility and, sticking power.
And
Second, it shifts the revenue stream from lower-margin components to much higher-margin finished modules. That's a key driver for the financial inflection we're about to talk about.
Okay, so if we connect this to the bigger picture, it's about positioning for a multi-year expansion. They already lead in EML or external modulated laser performance.
Which is state-of-the-art right now, yeah. But the future is that transition to the even higher-margin 1.6 terabit transceivers and eventually to co-packaged optics. CPO.
CPO is where the real architectural revolution happens. We probably should spend a moment on that because it's the ultimate long-term goal for these massive data centers.
I agree. CPO isn't just a faster plug-in module. It's a radical shift where the optics move right next to the ASIC, or the GPU on the board.
So it massively reduces the distance the electrical signal has to travel.
Exactly. And that leads to exponential reductions in power consumption and latency. Hyperscalers are desperate to manage the massive power budget of these AI clusters. CPO is the solution.
And Lumentum's NNP tech is positioned to be central to this shift.
Right. It represents a multi-year runway that extends well beyond just the current cycle.
So we have the tech moat and the market demand, but a great technology doesn't always equal a great investment if the execution isn't there. This brings us to the financials.
And this is where the story gets really interesting. The earnings inflection. The growth here, it's not linear, it's exponential.
Let's start with the full year FY25 revenue. It was $1.65 billion. That's a solid 21% year-over-year growth. Healthy, but maybe not exceptional.
Right. But that full year number doesn't capture the acceleration. You have to look at the quarter-over-quarter change. The company booked $533.8 million in Q1 of FY26.
Which is a massive 58.4% year-over-year growth.
Exactly. That suggests the AI ramp has moved from a steady climb to an intense sprint in just the last 6 months.
And beyond the sheer growth, what should reassure you is the consistency. They've delivered 8 consecutive quarters of earnings beats.
That isn't luck. That shows exceptional operational excellence and really strong visibility into their order books from those key hyperscale customers.
For example, their Q4 FY25 non-GAAP EPS of 88 cents, that beat forecasts by 10%.
Easily.
Let's focus on the margin expansion, because this is the fundamental justification for the stock's revaluation. Full-year FY25 non-GAAP operating margin reached 9.7%.
Now, that raw number might sound modest, but the context is everything. It was up a massive 1,030 basis points from FY24.
1,000 basis points.
1,000. To put that jargon into context, that is essentially a tenfold increase in profitability leverage compared to the previous year. It just highlights the scaling power of these proprietary components.
When demand outstrips supply this severely, the supplier captures almost all of the economic upside.
And the margin story is only accelerating. Q4 FY25 non-GAAP gross margin hit 37.8%, up 260 basis points sequentially.
And management's been clear about this. The new 1.6 terabit modules, they carry significantly higher margins than the previous generation.
So this trend of expanding profitability is directly linked to the success of that 1.6T product ramp.
And speaking of what's to come, the forward guidance is exceptionally constructive. I mean, aggressive.
Very aggressive. Management guided Q2 FY26 revenue between $630 and $670 million. But look at the earnings per share guidance for that quarter.
$1.30 to $1.50.
Which implies another sharp, material step up in profitability.
And they are setting the long-term bar even higher. They're explicitly targeting future gross margins close to 40%.
And non-GAAP operating margins of 16 to 17.5%. Hitting those targets would cement the case that this is no longer a cyclical component vendor,
but a high-margin AI infrastructure play.
And they are in a remarkably solid position to fund this rapid expansion. They have a strong balance sheet with about $877 million in cash in short-term investments. That's dry powder.
And they recently secured a new credit facility, right?
A new $400 million senior secured revolving credit facility. It just enhances their liquidity and, crucially, increases their capacity to build out manufacturing to meet this staggering AI demand.
Okay, now let's pivot from the fundamentals to the technical reality of the stock. A 370% price surge is just astounding.
It is. This requires massive conviction from the market, and the charts really confirm that momentum.
The technical indicators support this being a sustained uptrend, not just a fleeting spike. The stock is trading significantly above its key moving average.
Right. The 50-day simple moving average is sitting around $299, while the 200-day is much lower, back at $189.
And trading above those two key levels with the shorter average above the longer one, that confirms what traders call a golden cross dynamic. It's a strong signal.
A very strong signal of sustained momentum. The market has fully embraced this AI optical supercycle thesis.
What's fascinating to me here is that despite this historic run-up, institutional confidence remains incredibly high.
Institutions own over 94% of the company's stock. We've seen continued large purchases from major funds, which suggests the smart money views this as an enduring structural story.
But wait, you mentioned 94% institutional ownership and a high beta. If ownership is that concentrated after a 370% run, doesn't that make the stock potentially brittle?
That's a great question.
I mean, if a few major funds decide to take profits, the floor could drop out quickly, regardless of the fundamentals. What's the risk there?
You're absolutely right to point that out. The beta for the stock is high, 1.51, so it moves 51% more aggressively than the broad market. That volatility is fundamentally driven by their operational strength, not just speculation. But you're right, that concentration means any negative news event is going to be amplified by institutional profit-taking.
And that leads us perfectly into the other side of the coin, the bear case, the risks.
And the elephant in the room has to be valuation compression risk.
Of course. The stock trades at a very high forward price-to-earnings ratio. There's minimal margin for error here. We are pricing in perfect execution for the next 2 or 3 years.
The counter-argument, which the bulls rely on, is that the PEG ratio is close to 1.0. That suggests it's arguably fair value relative to the triple-digit earnings growth the market is anticipating.
But isn't valuation compression the risk for every growth stock? What makes Lumentum uniquely vulnerable right now, beyond just the high multiple?
It's uniquely vulnerable because that high valuation is tied to the sustainability of its technological moat. And in the tech world, Moats are, well, they're temporary.
Competitors aren't standing still.
They're heavily investing in alternatives. This is the competition and technology transition risk. We've established their dominance in indium phosphide lasers. But competitors like Coherent and Marvell are pouring resources into silicon photonics.
Right. The core threat is that Lumentum's proprietary NMP laser moat could erode quickly if silicon photonics, which is cheaper to manufacture at scale, gains traction faster than anticipated.
If it becomes the new standard for interconnects, yeah, silicon photonics is catching up on performance, and if they surpass NMP in power efficiency for next-gen architectures, Lumentum faces a severe risk.
So why hasn't a major player like a Broadcom or an NVIDIA just bought or built their way into ANP leadership? What is the real barrier to entry here?
It's the decades of expertise and the immense capital cost of these specialized fabrication facilities. You can't just spin up an ENP fab overnight. It's a very niche field.
Sure.
That said, the threat isn't just external. There's internal execution risk.
Tied to ramping up those high-margin 1.6 terabit transceivers and the co-packaged optics.
Exactly. If they experience any production delays, yield issues on the complex chips, or just slower customer adoption, it could severely pressure those ambitious 40% gross margin targets.
And we can't overlook the balance sheet risk when looking at the downside.
Right. While they have cash, some reports show their debt-to-equity ratio is as high as 4.2. That's significant leverage. High leverage means any sudden downturn in AI spending could quickly turn that financial flexibility into financial distress.
So this analysis really requires us to watch the next 3 months intensely. The catalysts are concentrated and they're high impact.
The primary near-term event, of course, is the Q2 FY26 earnings report expected around February 3rd. This is the moment of truth.
The market will be scrutinizing every detail. The 1.6T ramp, the sustainability of margin gains.
They absolutely have to deliver on that $1.30 to $1.50 EPS guidance to maintain confidence in this valuation.
And beyond the company itself, we're watching secondary market catalysts. Macro data in January U.S. payrolls, the CPI reports, that's going to influence Fed rate expectations.
And consequently, the valuation of high-growth tech stocks like this one. If inflation spikes, high-multiple stocks get hit hard.
On the product side, we're also waiting for the potential official launch of the R64 optical circuit switch.
Right, which is cited as a major near-term growth driver in the AI and data center vertical. Its adoption would really solidify their systems-level partnership role.
At the end of the day, though, the biggest macro tailwind is just continued intense AI infrastructure spending.
That's the core of it. But there's also some optimistic speculative chatter floating around. Rumors of a potential expansion of their LITE acquisition.
And maybe some deep co-development or long-term capacity agreements with the major hyperscalers, locking in demand for the next few years.
So what does this all mean for you? Lumentum has established itself as an AI optics leader with outstanding fundamental momentum, driven by proprietary technology and a rapid structural margin expansion.
Despite the very high valuation risk and that inherent volatility, the strong earnings trajectory, especially if they hit or beat that Q2 guidance, combined with significant institutional ownership, suggests there's still upside potential.
Provided they execute flawlessly against that rising tide of competition.
For the investor with a multi-quarter horizon, the smart move is to watch for tactical entry points around key support levels ahead of that crucial February earnings report, positioning for the sustained AI optical supercycle. Make sure you subscribe to stay on top of those key reports as they drop.